In this module, we'll decode RWA yields. What's actually behind that APY number, how pricing works, and how fees and risk premiums stack up. By the end, you'll be able to compare any RWA yield with your current DeFi strategies on a true apples-to-apples basis. Before comparing any yield, you need to normalize APR and APY. APR is a simple annual rate. If it says 10%, you earn 10% of your principal over a year, assuming you never reinvest. It grows in a straight linear way. APY bakes in compounding. A 10% APY assumes you keep rolling profits back in each period, so the base grows and the curve bends upward. Because crypto marketing loves big APY numbers. Always ask, what compounding schedule are they assuming? And is it realistic for how you'll actually use the strategy? When you see a juicy headline, APY, think of it as the outer skin of an onion. Your actual net real yield is what's left after every drag gets peeled away. First, subtract protocol and management fees. Then trading slippage and on and off ramp costs. Then the expected default losses baked into the asset. What remains is the yield you truly earn for taking risks. Throughout this course, that net, reality-based number is what we'll use to compare opportunities, not the marketing yield. So when you see a headline, APY, treat it as the starting point, not the answer. First, strip out all ongoing friction, management and protocol fees, gas, and any FX costs if it's cross-border. That's the price you pay just to access the strategy. Next, budget for expected credit losses. Even if defaults are rare, you should assume an average loss over time. The result is your net real yield, the figure that actually belongs side by side with other DeFi and RWA strategies. Now let's layer in two hidden frictions that don't show up in the APY: volatility and liquidity. High volatility forces you to over-collateralize or keep extra stablecoins on the side. That idle capital quietly drags down your true portfolio return. On the liquidity side, wide spreads and shallow markets act like invisible entry and exit taxes. Lockups and redemption gates trap capital, so you lose the flexibility to rotate into better opportunities as market conditions change. With that in mind, don't treat an RWA yield as magic. Think of it as stacked layers. The base layer is the risk-free rate, usually something like short-term US Treasuries, the part you could earn without taking credit risk. On top of that sits the risk premium, or spread. This compensates you for extra risks: borrowers defaulting, assets being illiquid, or legal enforcement failing. So an 8% RWA yield might be 5% risk-free plus a 3% spread, minus whatever fees and costs the structure charges. Yield is really just a price tag on risk. When spreads are very low, it usually means either everyone wants this asset, or the market is underestimating the chance of loss. You're not being paid much to hold the bag if things break. The sweet spot is in the middle: yield that looks boring, but lines up with asset quality, structure, and liquidity. When APY looks extreme, assume danger first: hidden leverage, weak legal rights, or purely inflationary token rewards. For any yield, ask a brutal question. If every token reward stopped tomorrow, what would still be paying you? That residual is the real economic yield: borrower interest, rents, or revenue from actual activity. Everything else is incentive yield: inflationary emissions and subsidies designed to bootstrap usage or liquidity. Incentives aren't bad, but they're temporary. In RWA, your core thesis should rest on durable economic yield, with incentives treated as a bonus, not the foundation of your returns. Most DeFi yields come from three engines you probably already use. Liquidity mining pays you with new tokens and fee subsidies. It's powerful but inflationary and usually temporary, so yields decay as emissions drop. Perpetual funding is driven by traders paying to be long or short. That yield is cyclical and very sentiment-driven. It can flip direction fast. Staking or proof-of-stake rewards are paid for securing a network. They're more structural, but tend to compress as the chain matures and competition increases. Now think of each yield type in terms of what's really paying you. RWAs are funded by external economic activity, so returns are usually more sustainable and less volatile, but you're taking credit and legal risk. Liquidity mining is the opposite. Yield comes from dilution and incentives. Very volatile, with smart contract and impermanent loss risk. Perp funding depends on traders' directional demand, so yields can spike but then crash. Lending and staking sit between these, with protocol design, utilization, and market risks. Yield strategies are regime dependent. Imagine one axis as macro interest rates and the other as the crypto cycle. When macro rates are high, safe RWAs like T-bills and strong private credit can carry your portfolio, even if crypto is sleepy. When macro rates are low but crypto is bullish, DeFi farming and perps tend to dominate. In between, you either focus on capital preservation with conservative credit and staking, or blend both worlds with hybrid, RWA-backed on-chain lending. Your mix should shift as regimes change. Within that shifting mix, think of RWAs as your portfolio's anchor. They provide a relatively stable macro rate base yield that doesn't depend on the current crypto narrative. From that base, you only rotate extra capital into higher octane plays when the odds are clearly in your favor. Perp funding is rich, LP incentives are exceptional, or staking yields truly compensate for volatility. The goal isn't to be all in or all out of crypto risk. It's to keep most of your wealth in durable, RWA-backed yield and treat DeFi trades as tactical overlays. To compare RWA opportunities, run this quick mental checklist. First, normalize. Convert every yield into a clean, net annual rate after all fees and compounding quirks. Second, benchmark it against a true risk-free rate and focus on the spread you're actually being paid. Third, separate durable contractual cash flows from short-term incentives or token emissions. Finally, place the trade within today's macro and crypto cycles to decide whether the risk-adjusted payoff is worth it.